Welcome back to the channel, and thank you for joining me. I'm Algabot, and today we're taking a close, educational look at a MetaTrader 5 expert advisor called Cumulative Delta Reversal. This is an order flow strategy that studies the balance of buying and selling pressure behind every candle, using a tool called Cumulative Volume Delta. Over the next few minutes, you'll learn how the strategy reads that hidden flow, how it spots a divergence between price and pressure, and how it manages every trade with volatility-based stops and targets. Let's get started. So what exactly does this expert advisor do? Cumulative Delta Reversal is a mean reversion or counter-trend strategy. Rather than chasing a move, it waits for a trend to reach a point of possible exhaustion and then positions for a turn. The engine behind it is order flow analysis through a tool called Cumulative Volume Delta, often shortened to CVD. Here's the core idea. Price alone only tells you where the market went. It doesn't tell you how much conviction was behind the move. Cumulative Volume Delta tries to fill that gap by estimating, bar by bar, whether buyers or sellers were more aggressive, and then keeping a running total. To do this without needing a specialized bid and ask data feed, the strategy uses the close location value. It looks at where each candle closed within its own range. A close near the high suggests buyers dominated the bar. A close near the low suggests sellers did. That reading is multiplied by the bar's tick volume and added to the running delta line. The strategy then compares two things over a rolling window, where price made its extreme and where the delta made its extreme. When price pushes to a fresh high or low but the delta refuses to follow, topping or bottoming out earlier and then reversing, that mismatch is called a divergence, and it is the classic signal this approach is built to fade. Every trade is protected with volatility-scaled risk. The stop-loss is a multiple of the average true range, and the take-profit is set as a reward-to-risk multiple of that stop. Only one position runs at a time. Who is this style suited for, in an educational sense? It tends to appeal to traders who are curious about order flow and comfortable with counter-trend setups on liquid markets. Think major foreign exchange pairs or indices on the 5-minute to 30-minute charts, where tick volume is a reasonable proxy for real activity. As always, this is educational information only, and trading always carries the risk of loss. Let's walk through the mechanics step by step, exactly as the code executes them. The expert advisor works on closed bars only, so it acts once per completed candle rather than on every tick. That keeps its signal stable. When a bar closes, the strategy first estimates that bar's sign volume. It calculates the close location value. It takes the distance from the close to the low, subtracts the distance from the high to the close, and divides by the total range. The result sits between -1 and +1. A value near +1 means the bar closed near its high, so buyers were in charge. A value near -1 means it closed near its low. That figure is multiplied by the bar's tick volume to give the bar's delta, and the delta is added to the running cumulative volume delta. Next, the strategy scans a rolling window, set by the DivLookback parameter with a default of 24 bars. Across that window, it locates four things: the highest close, the lowest close, the highest point of the delta, and the lowest point of the delta. Now the divergence test. For a short signal, the most recent bar must be the window's high, but the delta must have peaked at least min separation bars earlier, 3 by default, and must have since faded from that peak by at least the DivRatio fraction of its range, 30% by default. On top of that, the signal bar itself must close lower than the previous bar, confirming the first turn downward. When all of those line up, the strategy opens a sell. For a long signal, everything mirrors. The most recent bar must be the window's low. The delta must have bottomed at least 3 bars earlier and recovered by at least 30% of its range, and the signal bar must close higher than the one before it. When that aligns, the strategy opens a buy. Risk management is identical on both sides and fully volatility-based. The strategy reads the average true range over the ATR period, 14 bars by default. The stop-loss is placed ATR stop multiple times that ATR beyond the entry, 1.5 times by default. The take profit is set at reward risk times the stop distance, a default of 1.8, so the target is wider than the risk. There is also a spread filter. If the current spread is wider than max spread points, the strategy skips the trade. Only one position per magic number is allowed at a time, and from there the stop and target manage the exit. Let's read the actual MetaTrader 5 code now, the way it appears in MetaEditor. At the top are the input parameters you can adjust. DivLookback sets the rolling window for finding price and delta extremes. Min separation is how many bars the delta extreme must lead the price extreme by. DivRatio is the minimum pullback in the delta as a fraction of its range for a divergence to count. ATR period, ATR stop multiple, and RewardRisk control the volatility-based stop and the reward-to-risk target. Max spread points filters out costly conditions, and lots and magic set the trade size and identifier. Below the inputs are the two signal blocks. The first is the bearish divergence, which produces a sell. Notice the condition. The most recent bar is the window's high close. The delta peak came at least min separation bars earlier. The delta has faded by at least DivRatio of its range, and the current bar closed lower. When all four are true, the code calls trade.sell. The entry is the bid price. The stop is placed the ATR distance above entry, and the take profit is projected reward risk times that distance below. The second block is the mirror image, the bullish divergence, which produces a buy. Here the most recent bar is the window's low close. The delta bottomed at least min separation bars earlier. It has recovered by at least DivRatio of its range, and the current bar closed higher. When those align, the code calls trade.buy, with the entry at the ask, the stop the ATR distance below, and the take profit the same reward to risk multiple above. Both sides are symmetrical, and the stop and target handle every exit. Let's bring the whole idea together on this illustration. On the upper panel you can see the price candles, and in the lower subpanel we've plotted the cumulative volume delta, the running tally of net buying versus selling pressure that this expert advisor watches on every closed bar. Keep your eye on how the two panels move together, and more importantly, on the moments when they disagree. We begin on the left, where price is drifting lower. The first few candles print red, each one closing beneath the last, and down in the subpanel the cumulative volume delta line drops sharply to its lowest point of the window. This is genuine selling pressure, and at this stage price and flow agree completely. Sellers are in control, and the delta confirms it. Now watch what happens next. Price keeps grinding lower, carving out one more marginally lower low, until it reaches a fresh low for the entire lookback window. But look down at the delta line. It is no longer falling with price. In fact, it has quietly turned up and is now sitting well above the trough it made several bars earlier. The strategy measures this gap. It requires the delta extreme to lead the price extreme by at least the minimum separation of 3 bars, and it requires the delta to have recovered by at least 30% of its range within the window. Both conditions are satisfied here. Price is making a new low, but the force behind that move has dried up. That is a bullish divergence. The final piece is confirmation. On the signal bar, price stops falling and closes upward, the first sign that sellers are spent. At that moment, the buy entry marker appears. The strategy places its stop a volatility-based distance below the entry, just under that fresh low, sized at the ATR multiple, and it sets a take-profit target at 1.8 times that stop distance. From here, price turns and begins to climb. Candle by candle, it works higher, the delta line rising alongside it now that buyers and flow agree again, until price reaches the take-profit target and the long trade closes for a completed reward-to-risk outcome. Now the mirror image sets up on the right side of the chart. Price is pushing higher into a strong advance. In the subpanel, the delta line surges to a fresh peak as aggressive buying lifts each candle. Again, price and flow are in agreement, and the trend looks healthy. But as price stretches to new highs, the delta begins to sag. Price prints its highest bar of the window, a tall candle that pokes above everything before it. Yet the cumulative volume delta has already topped out several bars earlier and is now fading well below its peak. The push to the new high simply is not backed by matching order flow. The strategy recognizes this bearish divergence. The delta peak leads the price peak by the minimum separation, and the delta has pulled back by more than the required fraction of its range. Confirmation arrives on the signal bar. Price closes lower than the bar before it, leaving a long upper wick of rejection behind. The sell entry marker appears. The strategy places its stop the same volatility scale distance above the entry, just beyond that fresh high, and projects a take profit at the same 1.8 reward-to-risk multiple below. Price then rolls over and works its way down, candle after candle, until it reaches the take profit target and the short trade is complete. Notice the symmetry. In both cases, the strategy waited for price to reach an extreme that flow no longer supported and only acted once the candle itself confirmed the turn. That patience, extreme, divergence, then confirmation, is the heart of how this approach aims to trade. That brings us to the end of our walkthrough of the Cumulative Delta Reversal Expert Advisor. Today we explored how Cumulative Volume Delta estimates the balance of buying and selling pressure, how the strategy looks for divergences between price and that flow at fresh extremes, and how it manages every trade with volatility-scaled stops and reward-to-risk targets. Remember, everything in this video is for educational purposes only and is not financial advice, a recommendation, or a solicitation to trade. Trading carries real risk, and losses do happen. If you found this analysis helpful, please like the video, leave a comment with any strategies you'd like me to break down next, and subscribe for more MetaTrader 5 strategy studies. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.